I view the world as defaulting. The entire global financial structure is in the process of defaulting. So I think it's a no-brainer. You just buy physical gold, you buy physical silver. You will have something when the smoke clears. If it were someone who had debt, then you've got to think, well, would I rather pay my debt down or would I rather hold gold or silver? I personally do still have some debt, very low interest rates, and that's why I've not paid it off. But I have gold, I have silver that could easily pay that off. And why would I want to give up ounces now to pay off a 3.5% loan or a 4% loan? You could see metals within a short period of time. Once this thing blows up, you could see metals double, triple. You could see 10 baggers.
The recent increase in the cost of financing government debt, as highlighted by the US Treasury's reported average interest rate of 3.15% as of January 31st, 2024, has become a growing concern. This spike in interest rates is a factor influencing financial dynamics. Precious metals expert Bill Holter's discussion of the decision between paying off debt and holding gold or silver gains relevance in this context. The relationship between interest rates and financial decisions becomes crucial, especially with the anticipation of a delay in interest rate cuts. Over the last 2 years, as the price of gold has risen by an average of 5.91%, U.S. inflation has also rose by an average of 6.6%. So while gold lost nearly 1% of its real value annually over this period, stock and bond indices lost 5.19% and 11.16% of real value, respectively, on an annual basis. Holter expresses concern about leverage-driven manipulation in the gold and silver markets through naked futures contracts. Meanwhile, opening with a distinctive perspective, he mentions J.P. Morgan's view on the unique value of gold and silver due to their resistance against default. Across all metals, we have the highest conviction on a bullish medium-term forecast for both gold and silver over the course of 2024 and into the first half of 2025, though timing and entry will continue to be critical, said Gregory Shearer, head of base and precious metals strategy at J.P. Morgan. While highlighting the metal flow from North America to Asia, Bill Holter notes premiums in Shanghai for gold and silver compared to COMEX and LBMA. Strong gold demand drove the price premium higher in China last month. It averaged $47 per ounce, 2.2%, a $9 monthly increase. Due to strong demand and a stable gold price, assets under management by Chinese-based gold ETFs rose from $113 million to $4 billion in January, an all-time high. Now we present the clips of Bill Holter's insights from his recent interview with SOAR Financially. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Gold has a new role. I think the role of gold is money and everything else is credit. I mean, J.P. Morgan testified close to those words in Congress. The reason you want to own gold or the reason you want to own silver is because they cannot default. And what we talked about earlier, the world being, or literally the whole world, but led by the U.S., is hyper indebted, and we're moving into the phase, and you're already starting to see it. We're moving into the default phase, and that's why you want to own gold. That's why you want to own silver, because in a world that is defaulting around you, gold nor silver can default. And it goes back to Richard Russell for years and years and years said, when it finally blows up and goes down, the one who loses the least will be the winner. There's not going to be any outright winners that profit from the collapse, but there will be those that have gold and silver. They will have capital when the system reboots, when the majority, especially if you agree with the great taking, which I do, because I do believe that that's the plan, is to basically take your assets. If you have capital when this thing reboots, your family will have wealth for generations upon generations. I think that's an easy one because there is all kinds of leverage in the gold and silver markets, but that leverage is to the short side. And there's leverage, obviously, in the stock market, the bond market, that's on the long side. In other words, borrowed money has been and is being used to prop up stocks, prop up bonds, but it's also being used to suppress the price of gold and silver. And it's done via naked futures contracts on both COMEX and the LBMA. So what that does is that increases the supply, if you will, but it's supply of paper metal. It's not real metal itself. Once credit breaks, that's when, or once credit is much more difficult to get, that's when you're going to see asset prices declining in vast swaths because the debt has been pulled. On the gold and silver side, the way to close that trade, they're going to be forced to buy, not sell, because they've already sold. The suppression scheme has been done with naked short contracts. Generalists basically chase trends. And what we just discussed, I mean, they've suppressed gold, they've suppressed price, they've suppressed the miners. So you're not going to have the generalists follow that because the price action has been horrible. They've painted the picture. So the generalists, what are they buying? They're buying the Magnificent Seven. As far as metal flowing out of North America, that's an easy one. All you have to do is look at the premium in Shanghai for gold of $50, and there's a premium north of $2 for silver on the Shanghai exchange versus the COMEX and the LBMA. So you've got natural arbitrage that's buying gold in the West, buying silver in the West, and selling it in Shanghai, selling it in the East. So you've got, and they're locking profit in on every single trade. It's automatic profit. As long as it gets delivered, it's insured, and you get paid on the other end. You've locked in a profit. So that's, you're watching metal flow from west to east.
During the interview, Bill Holter underscored Japan and China's shift from US Treasuries, noting the rise of the BRICS alliance. He sees this as the strategic shift to replace dollar reserves with tangible assets in the face of fiat currency collapse. According to a report by Watcher.guru website, Russia, China, and India have ditched the US dollar in 95% of their trade transactions as a sign of growing de-dollarization efforts by the three main members of the BRICS bloc of emerging economies. The report states, often in the past, both the dollar and gold have been seen as havens, but now gold is much safer. During the short banking crisis in March, gold kept rising while the dollar drifted down. The difference in the movement of the two has never been so large. In his assessment during the interview, Holter anticipated external factors pushing the Fed to cut rates, yet he stated the dollar's decline would compel defensive rate hikes. Let's get back to the interview.
Foreign buyers, I mean, look at Japan and China. They were the two biggest holders of treasuries. They've been bleeding their treasury holdings down for years. And just look at the BRICS. Why is there such a thing as the union of the BRICS? The whole idea behind it is they want to get out from under the boot of the US dollar. They understand that the dollar is strictly a fiat currency. It's a Ponzi scheme. And I mean, if you listen or read any of Putin's speeches, you'll hear him every time say, we want to do business. The trade that we do, we want to be fair trade and fairly settled. In other words, they want to trade something real for something real as opposed to something real for something that's nothing. And that's what the deal is. I mean, the U.S. does not. I mean, we have a huge trade deficit because we get products in and we send freely printed dollars back out. That's why there is a BRICS, because they want to get away from, their view is the danger of holding dollars. And that's one reason why many of these central banks have been buying gold very, very strongly for the last 2 or 3 years, because they understand where this goes. They're going to end up with big black holes within their balance sheet that used to be dollars. So they're trying to replace those with something that's real and something that will go up in purchasing power as all these fiat currencies collapse. I don't think the Fed is going to cut rates just on their own. I think they're going to wait for some type of, I think they're going to be forced into making a cut. But when all is said and done, I do believe that the dollar is going to be crashing so badly that the Fed is going to have their hand forced, and they're going to have to tighten rates, have to raise rates as the only way to protect the dollar. So I guess my answer is the Fed's in a box, because if they lower rates from here, then you're going to kick off just natural dollar weakness. And that will coincide with some type of a negative event, whether it be uh, a bank's going under, uh, you get a slew of real estate foreclosures, big commercial real estate foreclosures. The the Fed will be forced into a cut is my belief, and I also believe that because of the action of the dollar, they're going to be forced into raising rates into a weak economy, which obviously that's not the policy they would prefer, but it's the policy they're going to have to do. Is they're going to have to raise rates to support the dollar, which again, raising rates on such a hyper indebted system, now now it's a systemic event.
According to JP Morgan research estimates, gold prices will peak at $2,300 in 2025. This prediction assumes a Fed cutting cycle, initially delivering 125 basis points of cuts over the second half of 2024, pushing gold prices to new nominal highs. Gold price predictions are based on Fed official forecasts, which see core inflation moderating to 2.4% in 2024 and 2.2% in 2025, before returning to the 2% target in 2026. How will the ongoing de-dollarization trend affect the global economy? And can gold maintain its status as a hedge following financial uncertainty? Share your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.